Hello, everybody. This is Kim Arthur from San Francisco with
James Maxwell.
James. Great to have you in
Yeah.
here as always. I thought we'd kind of give the advisors and clients a little update on the macro outlook for the second quarter of 25. Before we hit that, just a quick reminder. Main Management, we are a team of 24. We've got a culture of client first with exceptional service. We're partner owned. We're 10% of the assets are partners' assets. So we are heavily aligned with you and your clients. Um, we've got a lot to cover here.
hmm
And as we go through this, we've got record policy uncertainty that we're going to address. We're going to talk about navigating Trump 2.0, the asteroid field. We'll talk a little bit about the Trump put, where is that, and the Powell put. And then we want to make sure that clients get a good idea of, based on history, are there better returns still in front of us? I know, James, you've got some great data that can cover all of that. So quickly, if you kind of look at the first quarter, the S&P was down 4, and you can see the 10-year was up 4. So it's interesting. If you widen the lens on that just slightly there, the last 3 years, S&P has been up a 9% level, but 10 years have been down 1, down 1. That 10-year should be more like up 3. So those have some catch up to do. And the S&P actually at +9 is right on. It's a little bit below its historical. So that shows me that things aren't completely out of whack, but the diversification from fixed income that so many
hmm
people gave up on, um, probably a good idea to have that in your asset allocation. I know you've got some good stats on that we'll hit. If you look at the sector size, if you look at tech, tech was down pretty hard here, down 13. Energy was up 10. If you look historically, the 3-year and historical, tech is up 10 on a 3-year basis. Historically, it should be better than the market, so up
hmm
12. So that may be, looking kind of attractive again. And energy, which was up 10, that 3-year is up 11. Historically, that's worse than the market, up 7. So that may be a little bit ahead of itself. Um, this is something to give people some perspective again, as we talked about based on history. What can you tell us about this, James?
Yeah, so obviously the big story this so far this year has been the equity market drawdown. Um, from close to close, you had a 18.9%
Wow.
drawdown. The peak was on February 19th. I think the bottom was right before Trump pulled back some of those or pushed off some of those 90-day delays of the tariffs. And basically what we looked at here is what's the average kind of peak to trough drawdown that you get in any typical year. The median over the past, call it, 70 years or so, is right around 10%.
Yep.
We're obviously a little higher than that at 18.9.
Or lower.
Yeah, or lower. But basically what you can see is that it's not all that uncommon to get a drawdown of this magnitude. It's kind of, every 3 to 4 years, you typically see some higher volatility where you get a drawdown in the 15 to 20 to 25% range.
And then it looks like from this, every 7 years or so, you get the one that's 20 plus.
Yeah, that's where the pain really hurts. It's like the longer the time frame, the more, the higher returns are
Yeah.
the higher the returns, and also the higher the drawdowns. It's kind of just like on that sweep of time, you're going to get bigger swings on either side.
Yep. And I can tell you from experience, because a lot of these 20 plus ones I've lived through in the market, the the good news is they're typically V's. So
hmm
the last 20 points happen so fast you can't even blink. And then you kind of, by the time you're ready to, take action, it's actually bounced up. So
Yeah.
that is another reason, like we always say, it's time in the market, not timing the market. Okay, this is the policy uncertainty. This is the policy uncertainty that we talked about at the beginning. For those of you that can't see the slide, it is at a record level. And this goes way, way back. Okay, this goes back to the 80s.
hmm
So you've had a lot of periods there. The only analog to this is COVID. And COVID was obviously unpredictable where this one is self-inflicted with the Trump tariffs. So that's a little bit, a couple other contrasts on it is back during the COVID period, inflation was 1.5. It's 2.5 plus now. 10-year was less than 1. It's 4.5%, 4.3%. Fed funds rates were 0 back in COVID. So they had gone to a 0 rate policy. They're 4+% right now. The market, I know, is assuming that there will potentially be a couple cuts in the back half of the year. And then the valuations back in that COVID plus, looking like during the period of time there, was 18 times forward. It's 19 times forward. So I think the big key difference, this is self-inflicted. So you don't need helicopter money coming in. But it does tell me, looking at these, that rates do need to come down. They are probably too high. They're too high. And I know we'll hit that in a minute, but markets abhor uncertainty. If we can get that uncertainty cleared up, and Trump does have the lever on that, then I think the back half of the year could be significantly better. All right, tariffs.
Yeah.
What do you see here?
So obviously this has been the big point of discussion. It's why the market's in a drawdown. What everyone's talking about is why the policy uncertainty is so high. This chart really looks at the average rate of U.S. imports, the average tariff rate on those imports. You can see how unprecedented this kind of move is over the past 100 years. I think
100 years.
Yeah.
Jeez.
So I think one thing that we try to look at is the actual kind of tariff rate. In this case, it's 11%. It shows it as 11%, but that's going to be changing probably every day or every week for the foreseeable future.
What was it last year?
Last year was 2.5%.
2.5. Gotcha.
So it's off of a very, very small base, almost the lowest ever, or around the lowest ever. And so the absolute magnitude is much higher than it was last year. I think the main thing that we're looking at is not so much the actual, starting point of where Trump has said the tariffs are going to be. That's only a starting point. Our view is that his way of negotiating is starting high and bringing it down. So looking at it right now, like I mentioned, every day he's having these negotiations, having these talks, whether it's different sectoral tariffs or certain countries bringing those down on a case by case. It's hard to exactly pinpoint what that's going to be, but I think this shows that no matter where he actually ends up, it's much higher than it was last year.
But at the same time, it's also much lower than the Liberation Day of 50 to 100%. And I think that's one thing to remember. If any of you have read The Art of the Deal, Trump is notorious for coming in with absurd numbers. So in our business, we call a bid and an ask. He blows that spread out. And then that creates space for negotiating, and that potentially you end up with a win-win, because the people that thought they were going to pay 50% tariffs, they end up paying 15, and they're like, whew, that's a victory. And then he can go back to his constituents and say, hey, it was 2.5. I now got it at 15.
Yep.
So interesting. GDP, let's not focus on that one, because there's a couple other things I think that are more relevant for it. First year of election cycle market returns. What is this telling us here?
Yeah, so this chart's looking at the average of the first year of a new president's term. And you can kind of see there's typically some volatility in February and March. Obviously, this time around has been more volatile than average. But over the course of the year, as the new president kind of gets into power in January, and then over the course of the year starts implementing their policies, typically the market does well in that environment. This is specifically looking at periods that are in bull markets, so starting the year in a bull market. Which
and we're in the third year of a bull market.
That's right. So typically this type of environment's pretty strong for equities. Obviously, you've seen some volatility in the beginning of this year, but looking on a look forward basis, we're still, we still feel good.
And it's interesting, we don't have it on this slide, but the start of the year, the Wall Street target price for the market was 6,600, which would kind of coincide with this up 13% that you show on this picture. Those have changed now to 5,900, which is up about 2%, which most of that is your dividend. So there's been a big, big, big reset. The bar has come down a heck of a lot lower, which is interesting. Usually you like to have that because it gives you the potential for an upside
Hmm.
surprise. What about this historical drawdowns?
Yeah, so obviously we entered a correction here. A correction's typically defined as a 10% peak to trough drawdown
Yep.
of the S&P 500. We almost have entered a bear market. We were right on that cusp of roughly 19%. We'll see if we enter that, unclear. But what this chart's looking at is it's looking at all of those corrections where we were down more than 10%, and then basically looks at, okay, if it doesn't enter bear market territory, what is the move? And if it does enter bear market territory, what is the move? And you can kind of see that if it ends up being a bear, those are more kind of longer lasting. They take longer to recover. It's typically around a year where it actually, gets back to all-time highs. Versus if it's just a correction, those are typically much faster, roughly 3 months back to all-time highs. So obviously every time is a little different. But if we're just looking at as sort of a guidepost, it looks like we might have bottomed here just based on the averages. But a lot of that is also to be determined based on the exact, strength and magnitude of the policy.
Yeah. So it's interesting. So for the person that is kind of the glass half full, an optimist, you'd look at this and say, all right, the lows were put in last week.
Hmm.
You still have a time duration. You're not going to have a V bottom.
Yep.
It's going to be more of an L shaped. Um, unless there is no recession, then you will get a quick
Yep.
recovery higher. Interesting. Yields, anything you want to talk about there? I know we mentioned that we think that the Trump administration is very, very focused on
Hmm.
this, which is why they need to get lower 10-year rates because
Hmm.
there's a lot of refinancing of the existing debt. And then obviously they're working on cost cutting so that you don't continue to add to the debt pile. Any thoughts that you have outside of
Yeah,
that?
I think you're absolutely right. Scott Besson has said that this is a point of focus for them, trying to get those kind of longer term yields down. They peaked last week and have kind of come down here. You can see the 10 years at 4.35, the 30 years at 4.79. Those are super critical to the housing market because of mortgages. So, for a lot of parts of the economy, especially the cyclical parts, getting those down is a goal of the administration.
Yeah, that's a great point. A great point. All right, the dollar index. This is obviously it's come off the highs.
Mhm.
That's part of this situation with the tariffs that will cause that to come down. It's also there's a couple benefits that happen out of this. One, which we'll talk about in the next slide here, is investing outside of the U.S.
Mhm.
The dollar is your biggest critical factor as far as whether you'll make excess returns outside of the US or you won't. Falling dollar, excess returns will happen outside. The second thing is 40% of the earnings of the S&P 500 come from outside the US.
Mhm.
So a weaker dollar actually translates into higher earnings. And
Mhm.
I know at the beginning of the year, people were panicked about the dollar going even higher. That would
Yep.
have been a headwind. So this is right now people can only think tariffs, 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 but this is interesting. Maybe on this slide here with international equities, why don't you walk us through this?
Yeah, so this is looking at the quarterly performance of the non-US stocks to US stocks, specifically the MSCI All Country World ex-US versus the S&P 500. And this is something that we've talked about for the past couple of years where you've had just significant underperformance by non-US companies, probably for 15 plus years, basically since kind of the '02 through '07 was really when the last kind of extended period of time where non-US did well. You've had some quarters that spiked up. I think there was one in 2022, the end of 2022. You've had kind of, you can see those spikes every couple of years. You have a spike. This past Q1 and then also even quarter to date so far have been, the largest in a very, very long time, basically since that '02 period. And to us, this shows the power of
Yeah.
diversification. A lot of the S&P 500 drawdown was due to kind of US centric issues or focus of these tariffs. So having a global diversification, having exposure to non-US equities has been out of favor for over a decade, probably 15 years. But I think this quarter and this year so far has really shown the power of not straying from that too far.
Yeah, and it's interesting, as you pointed out there, 3 of the last 4 quarters,
Hmm.
international has actually outperformed. You could win a bar bet on that.
Yeah.
I guarantee you, because most people, like you said, are underinvested because it was so persistent for a
Hmm.
decade, they just gave up. It was a little like the fixed income. They had 5 years where it wasn't working. But typically there is reversion to the
Yeah.
mean that will happen. So I think that's a very good point for people to keep in mind. All right, this is looking at um, if in fact we have a bear market, what the returns look like for +6 months and
Hmm.
+12 months, and if there is no recession.
Hmm.
So the recession, if you have a recession, it's probably going to be a bear market. If there is no recession, and what I can see from this here is these dark blue bars, 6 months out
Hmm.
from now, if there is a recession, that's not our base case, you're down 4%.
Yep.
But 12 months out from now, you're up 9.
Hmm.
And why don't you give us what's the bull case if there is no recession? Where are you 6 months and 9 months or
Yeah.
12
So
months out?
just on the averages, you're up 12, 13% on the 6 months, and then as the chart shows, 18% on the 12 months. So typically what kind of happens is the equity market looks out if it's sniffing a recession, you get that bear market, you get this massive drawdown. If the recession does not end up happening, you get a pretty strong recovery on the upside, basically because expectations were better than expected. And then even if there is a recession, it's usually maybe there's slightly more to price in, kind of that down four. But looking out a year, the equity market's usually the first thing to bottom of any sort of indicator, and it's already starting. As soon as the recession happens, it's already starting to look at the recovery. It's looking at, okay, what's the next thing happen? It's
Yeah.
looking 12 months out, 18 months out. So that's kind of the view that we have is the market's down, or it got down to basically down 20. Uh, it was clearly pricing in a lot of economic slowdown, a lot of hurt. So to say, oh, well, there's a recession coming, so we know it's going to be down another 20 is kind of, that's not really realistic.
Yep.
There was already a lot of that priced in.
Yeah. And for listeners out there, any given year, there's a 15% chance of a recession.
Yeah.
It's basically 1 out of every 7 years. So this year started at 20. People got it as high as 65% when Liberation Day came out. And it's kind of pulled back to probably below 50% now.
Hmm.
Our base case coming into the year was no recession. Again, our base case right now is that Trump, this is self-inflicted. So Trump has the ability, and right now, remember, he is parading through people. In the last 48 hours, he's had, quote, a great conversation with Japan, a great call with Mexico. He's
Hmm.
meeting with Italy right now. He says China wants to negotiate. So he's highly incentivized to get something to work. And I think that if you can get stuff resolved between now and let's say the next 3, 4 months,
Hmm.
you probably will avoid a recession. If for some reason he digs his heels in, it will be potential recession. Fed funds futures, quickly on that. This is kind of on the Powell put
Hmm.
that we said that we would address. It feels like Powell is still fighting the last battle of inflation, and that the Powell put for the stock market is below the lows of last week of 4,800. Anything else you would kind of throw in there?
Yeah, I think Powell's just kind of remained on the sidelines here. I have been saying it's kind of funny, this is the first time in a long time that the Fed hasn't led the headlines. Probably feels a bit nice for him to not have all the focus on him, but
That's a great point.
even still, I think people are looking at them, and yesterday he spoke, and it was all eyes on him. Where
Yeah,
um, is there a Fed put here? What's
yeah,
their kind of what are their risks? What are their views? It looks like they're basically just watching the actual data and kind of
yeah.
seeing it as it comes in, and aren't super dovish, aren't going to like step in and stimulate massively like something like COVID.
Yeah. not to beat a dead horse, remember, inflation went from 1.5% to almost 9% before the Fed began to
Yep.
raise rates. And quantitative easing, which is another policy to keep rates even lower there, same thing happened there. They were still doing quantitative easing as we were approaching
Hmm.
9% rates. So he has been so late here. So there needs to be some rate cuts, but right now I think that the Powell put is significantly lower. Um, all right, inflation. Again, I look at the sector performance of inflation sensitives. So those
Hmm.
are energy, materials, real estate, and industrials. They have been underperforming the
Hmm.
S&P, which is the market voting that there is no
Yeah.
inflation. Okay, the market's a lot bigger and more robust than 12 Fed voting members. I would just point that out. The 2-year market says that rates should be 50 basis points lower than they are right now. They should be down at like 3.7%. That is a much more liquid and bigger market than 12 voters. So I think it's just something to keep in mind. Obviously, you got to have the 12 voters
Hmm.
because they control the thing, but there are some market pieces to look at. What's going on in the labor market with this picture, non-farm payrolls?
Yeah, you've seen kind of this continued slowing over the past, call it year and a half. The past few months have actually been stronger than average in expectations. So overall, our view is that the labor market's kind of stabilized here,
Yeah.
right around break even jobs rate. But on a look forward basis, it very much depends on what's going on in the economy. If there's a slowdown, jobs will like fall. But as a driver, it seems like it's kind of just stabilized.
Yeah. And what's important here, we've got a slide coming up showing about real wage growth,
Hmm.
which is extremely important. It
Yep.
ties back into the labor market here because 70% of our economy is driven by the consumer and they need real wages, which you'll see they do have. All right, consumer sentiment. You can see from this one. Now, this is a short sweep of time. It only goes from the previous administration to the current. And you can tell it's very politicized when you have inflation expectations and sentiment. So during the previous Democratic administration, on the sentiment side, you had the Democratic poll people that were being polled were always more optimistic than the Republicans. That's flipped now because now you have a Republican in the White House. So it's not like it's something new. It has been going
Hmm.
on. And on the inflation expectation, the previous administration, the Democratic voters, when they were polled, they thought that there was no inflation, where the Republicans said there was. Actually, in that case, the Republicans were much closer to the true inflation. And now that's flipped. But that's just sort of a construct of what we have. There's other things to look at that are probably more relevant. But one thing that's definitely been persistent for the last few years here is sentiment has been very disconnected from the equity markets. Usually, if you have rock bottom sentiment, you don't have the markets where they are. But see, um, productivity growth. This is obviously extremely important. What's driving this, and where do you see it going?
Yeah, so productivity is on the long term really the lifeblood of economic growth. It's really just the biggest factor that drives any sort of economy to grow in the long term. In terms of drivers, artificial intelligence is the largest one. It's funny, AI has been a focus, a topic of conversation for a number of years now, and it's kind of disappeared from the narrative recently. Obviously, there's the tariffs and there's policy and there's all of that, but AI as a talking point has really taken a back seat, even as the technology itself is just continuing to improve at a very, very rapid pace. So it's kind of funny, you were talking about this where you have with these nascent technologies, you have the initial kind of hype cycle, all the eyes are on it, and then maybe that hype is a little more than it actually should be. It kind of crashes to the downside. People stop looking at it all the while the actual technology continues to improve. It actually kind of reaches that tipping point of scale and adoption and actually starts to you know, get that widespread adoption. So that's probably a similar case here, maybe not to the same extent as something
Yeah.
like the internet, but a similar idea where the hype cycle is very cyclical.
And what it does is it gives you an opportunity that when the market, starts saying, oh, there is no addressable market for AI,
Yeah.
they're dead wrong on that. And so that gives you a chance to kind of like leg into some of these names here. So very interesting. This is the real wage piece here that I mentioned earlier there. You've had positive real wages now for 2 years. Extremely important, extremely important. Prior to that, you had 2 years of negative wages. Now, what offset it was the helicopter money when they were sending checks. That's not sustainable. Real wages are. So real, wages are running up 4, inflation's up, high 2, so you have positive 1+%. So that is continuing to drive, and we think that will be continuing to happen. Let's go quickly through some of these earnings ones here. And I'm going to let you talk on the next slide. This one I'll just kind of hit. What this is showing, the current first quarter earnings are being reported. They had started out at like up 10% year over year, and then when the reporting season started, it was like high sixes. That's very normal, and you're going to address that in the next picture. We think that number comes out at up 10% most likely as we're reporting through this. And it's kind of a feature of what happens. And in fact, here's the picture.
Yep.
You put this together.
Yeah. So if some people have been out there kind of saying, "Oh, look at estimate revisions. All the estimates are coming down. This is showing how the market's falling apart, how the economy's falling apart. This is all these tariffs doing this." It's kind of funny if you look at the actual kind of estimate revisions of 2025 and 2026. First on 2025, the revisions were very, very strong last year. So you've kind of seen some pulling back from that. What this chart's actually looking at, just to clarify, those dark blue lines are the median and average of just any year, what the typical kind of revisions look like over the course of time. So typically estimates start high.
Yep.
Over the course of time, they get revised down to a more accurate number. 7 to 9% is typically the normal kind of revision off the starting point. And 2025 is still running above that trend. 2026 is kind of just in line with that trend. In other words, nothing really of note for 2026.
Yep.
It's about what you'd expect just for any given year, and then 2025 is actually still stronger than average.
And that's what I love that you guys do in the research there, is that you put things into perspective, because just someone saying, oh, the 2026 numbers, they're down 2%, things are falling apart. It's like, okay, well, what's history telling me?
Yeah.
Oh, well, history tells me you're right in line.
Yeah.
So I think that's very important. I think you guys do a great job with that. All right, this is our recession watch that we have 9 different indicators that are on it. And we're constantly monitoring this. You got a lot of neutrals and a couple greens right now, but there's some of these neutrals that could very easily flip. The consumer, if we can get this policy uncertainty cleaned up here, that can flip up higher. PMI, which is very geared towards a lot of the onshoring and manufacturing, that should flip up also, because we've got a lot of announced manufacturing buildings, so that could go up. Housing, like you mentioned earlier, if we get a couple rate cuts and but it's more levered to the 10-year, like you said, if the administration can get that 10-year to come down, you can see a big explosion in housing, because there's a lot of pent-up demand, but the prices are still a little high. So the message being that there's a lot of these geared that can move higher, and what that'll do is feed into the last chart here, which is our earnings and forecast. And you can see on that, we've got a downside of 5,000, an upside of 5,900. That's just for the next 8 months. I want people to keep that in mind. They're 12 months out. If we put this on, they would be even a better risk reward. But even at that price targets there's 2 times the upside as downside from the last sale. That's typically very attractive. And I think on top of that, we mentioned earlier that there is a Trump put, and we saw that kind of exercise last week at 5,000, and you saw a little bit of it here as we got down to 5,200 yesterday. So I do think, not that that's the only thing that would hold it, but I do think that there is somewhat of a Trump put for the various reasons that, again, it's in his control to get these tariffs fixed. And remember, he has what he calls his 1BBB, the one big beautiful bill. That's out of his control. That's in the House's control. and that's in the Senate's
Hmm.
control. He's going to need political capital to
Yep.
make sure he delivers a appropriate tariff that doesn't kill his constituents or the constituents of those people.
Yep.
So he's going to need help. He's going to need help. And that's what I think will eventually happen, that he can't, he can control the tariff side here,
Yep.
but the other side that he really needs. So last thing I wanted to mention, and you can briefly jump on this one here, is we obviously, I want to reiterate that it's time in the market, not timing the market. I want to reiterate the great partnership we have with all of our advisors. And we couldn't do this without you guys. And I want to also mention the model building that you and your team are in control of. And in that model building that we do, why don't you hit quickly on diversification, because we've got a couple features that are going on right now.
Yeah, one thing I mentioned earlier is this quarter, this kind of year has shown, if anything, the importance of diversification. I think a lot of people, got hurt by international equities, got hurt by fixed income, and kind of said, okay, well, I'm going to go into the thing that hasn't hurt me, U.S. equities. And that felt good for a little bit there. And so far year to date, that's if you were just in U.S. equities, that definitely hurt you. I think this shows the power of, again, diversification and being, globally and internationally diversified. So I think in our kind of philosophy, when helping advisors, when being that consultant and helping them with models for their end clients, being globally diversified, really fitting in their risk tolerances, their risk spectrum, that's a really key tenet for us.
Yeah, I've always said that when you look at your asset allocation, you better have something that's either red, losing money, or underperforming.
Mhm.
Otherwise, you have a lot of
Yeah.
risk when there's
Yeah.
a rotation. You don't know when the rotations are going to happen. And I know it doesn't feel good. People are like, I don't want anything red. I don't want anything underperforming. But you have to look at the aggregate. If
Mhm.
the aggregate, again, for a global diversified portfolio, if it's delivering you mid to high single digit returns, that's doing its job.
Yep.
And under the cover, there might be something that's double digits, something that's kind of flat line.
Mhm.
That feature is good. But if you have everything that looks to be, outperforming,
Yep.
you're going to be in trouble. And then you start panicking. So.
Yep.
All right. Well, I'm glad we have the time to catch up and go through this again. I want to, thank our partners out there. We're always available here, and James, awesome as always.
Yeah. Appreciate the partnership. Thank you.
Thanks, everyone.